is Fed Friday, and what a great Friday it is today.
Yes, it is.
Is everybody out there enjoying this weather? Welcome, Facebook. I hope you're joining us out there on Facebook. Today is going to be a great Fed Friday series. We have a special guest host here, one of our other team members, Javon Walker. So according to my watch, it's 10 o'clock. Is it 10 o'clock on your watches, ladies?
Yes, it is.
All right, Rita, unmute yourself so everybody can hear you say something because you're muted.
Hello and goodbye. Have a fantastic weekend. I'm out.
All right, so we're going to go ahead and get started. As I said, this is our Fed Friday series. Of those of you who are watching us on Facebook, we broadcast live simultaneously, and we're pulling back the curtains just to give you an in-depth knowledge on your federal benefits. But the information that we're going over today is not just for Fed employees, it's for everybody. You want to spread the word. If you can't get on Facebook, go ahead and register for our webinar at www.RitaBRowland events, and it's right there on your screen. Make sure you like us and follow us on Facebook and share us. Don't keep us a secret. So, as I said, we have a special host with us, one of our other team members, Javon Walker. Say hi, Javon.
Hello, everybody.
She had some great information she's going to be sharing with you. Disclaimer real quick, the information we're going over is very general in nature. Without knowing your individual situation, we can't make a recommendation directly for you, but what you can do is that you can give us a call at Affordable Benefit Solutions so we can sit down with you and give you a direct recommendation for the information that you'll see here on our broadcast. So as we said, this is Life Insurance Awareness Month. So that's what we're going over, life insurance issues. Last week, remember, I went over and explained to you the difference between term insurance and permanent insurance. And that's where we're going to pick up. Keeping in mind, term insurance, you're renting your apartment. Permanent insurance, you're buying your house. So with that in mind, now I'm going to be talking about renting your term insurance. That's term insurance, renting your apartment. So I'm going to go over some of the features of your term apartment. Javon, my co-host today, she's going to be going over, helping you buy a house, giving you a permanent policy. So what is term insurance? Term insurance is just coverage that you have in effect for a specified period. Okay, and it's just pure life insurance because it only provides a death benefit only, no cash value at all. So how does it work? You choose the length of the term that you want. Term policies generally come in 5-year, 10-year, or 20-year and 30-year. Now, there are some policies out there that are 1 year, meaning they renew every single year. There are different types of term insurance. You have level insurance. That's where you see the 10, 15, 20, and 30. That means the premiums are level for the length of your term. Then you have increasing term insurance. Government employees, that's what your FAGLI option B is, increasing term insurance, meaning at the end of the specified period, either 1 year or 5 years, as in the FAGLI, the premiums go up. So you have an increasing term policy. Then the last type is a decreasing term policy. When you buy your mortgage protection insurance through your mortgage company, you're buying decreasing term insurance. What do I mean? You get the mortgage protection because you want to make sure if something happens to you, your home is paid off, right? Exactly. However, when you buy through the mortgage company, so your mortgage starts off at $300,000. But each year you pay on it, the mortgage is less and less that you owe. So when you pass away 10, 20 years into your mortgage, they just pay off the remaining balance of the mortgage. Versus when you come to a financial firm like us at Affordable Benefit Solutions, if you get mortgage protection with us, you're getting the level term insurance. Meaning if you get a 30-year term policy for your 30-year mortgage or 20-year, depending on your age, because the level that you can get does depend on your age. If you pass away 20 years into your 30-year level mortgage protection, and it's $300,000, that's what your family gets, not just the remaining to pay off the balance, but they actually get the entire $300,000. So you have to ask yourself, which would you prefer your family to have? the full value of your original mortgage, or the mortgage company keeping everything and your family getting nothing. So those are the types, and then I'm just going to go over. So what are the advantages of term insurance? Because term insurance is neither good nor bad. It's just what it is. But the advantage is that, number one, just like I told you before, term insurance is very inexpensive initially. It doesn't cost a lot to get into an apartment. It doesn't cost a lot to get into term insurance, especially when you're young. And it allows you an opportunity to get that high amount of coverage that you need at a lower cost. But again, as I stated, just like when you're in an apartment, the disadvantage is that as you continue to stay in the policy, at the end of each term, the cost, the premiums, they go up. And just like in your apartment, when you move out, there are no savings. Your landlord isn't going to give you your, I'm happy you're getting ready to buy a house fund. Your term policy, it has no cash savings. So at the end of the term, you're still here, and your coverage, if you don't choose to renew it, is over. So that's the gist of the term insurance. And now Javon, she's going to give us some better news, some good news about using the permanent insurance for our retirement needs, because I know that's what everybody wants to know about. So Javon, go ahead, take over.
Awesome. Good morning, everybody. Hope everybody's doing wonderful. Darlene did an excellent job explaining the benefits or the details of how term insurance work. I want to look at the other side, because it's only two types of insurance. One is term and one is permanent. I want to just share some of the benefits of the permanent plans and how you're able to utilize these plans for retirement supplementing, as well as what's called a concept that we call be your own banker, you be the bank, things like that. So I want to start out by first asking everybody a question. All right. And that question simply is, how do I want to explain it? If 95% of America have less than $1,000 saved, or $25,000 at retirement, and when we think about the type of debt that our government has, the deficit that we're now in, and all of that good stuff, my question is, where do you guys think the government is going to get the money to pay for all of this debt and all of these expenses that we have? That's a question that I want you guys to think about. So some of you might be saying, I don't know. But I want to share where I think they're going to get the money. And they're going to get the money from people like you, people who have the money. So if 95% don't have the money, then you got the 5% who does have the money. So that leaves them no other place to go to get the money but from the people who have the money. And that's people who have the money in their TSPs, IRAs, 401ks, things like that. And so if you knew that to be true, my question for you all today is, what are we going to do about it? What are you going to do about it to prevent this from happening? And so to take this question to ponder on a little bit further, I want to remind you guys that there are only two pots of money when it comes to retirement, okay? That pot of money, one is called taxable. The other one is called tax-free, okay? Now, under the taxable part of pool of money, you have your stocks, your mutual funds, your real estate, things like that, all of which are exposed to capital gains tax, 15% after year one. Then you have your wages, your qualified plans like the TSP that I've referenced, your 401k, what is the other one? Just 403Bs, things like that, just giving an example. Okay.
All of so they can get a better visual.
I'm sorry?
I said, did you want to share your screen so they can get a better visual?
I don't have this visual here.
Okay.
Yeah, this one I don't have, but I have one coming up. And so all of these are taxed at ordinary income. So this is how they're going to get the money from you, right? Then you have the tax-free pot. And this is where you'll have your municipal bonds there. The only problem with those is that they're barely beating inflation today. The counties are broke, right? Then you have your Roth IRAs. And then, so some of the issues that reside there is that, again, its income is based off of your income, and it has contribution limits. So you can't really build a whole lot of wealth only contributing about $5,000 a year, right? And then lastly, it's life insurance. Those are the only three that fall under the tax-free pot. So we want to talk about life insurance today because that's the one that we like the most out of all three of those options there. And simply because life insurance provides that tax-free benefit from you, not just when you die, but also while you're living. And so when Darlene referenced the screen about how, permanent insurance is like buying a house. We know how a house grows equity after you pay on it year after year after year. And even when you decide to pay it off and it's free and clear, that equity still grows. Well, the same concept works the same way with life insurance. Instead, it's not called equity, it's called cash value. Okay? It's called cash value, and that cash value is valuable. It's so many things that cash value allows you to do. I don't have time to get into all the details of how this works, okay? But I want you just to understand how the wealthy people who have had access to this type of information, how they've been using life insurance to fund their retirement, to supplement their retirement, and hundreds of other things that their lifestyle desires. I see you, Darlene. I don't know if they can see you or if they'll see me.
They're seeing you as well.
Oh, okay. Okay.
And so everybody, she hasn't used our webinar series, but yes, honey, they're seeing you as well.
Okay, excellent. And so what I want to do today is to help you to understand that when you look at your portfolio for retirement, you have to ask yourself, do I have anything that's protected, that I have control of, that the government can't necessarily just seize or freeze? Because just as a sidebar, and this is just not to bring doom and gloom or anything, but we need to know what's happening right under our noses, right behind the scenes. Things that happened back in 2008 where our whole system crashed and 24% of the assets from liquid money markets and stuff was pulled out, which caused our whole system to almost totally collapse, right? So 2010, there came a law that was put into place that will basically give banks the green light to freeze the monies that's in your accounts, okay, and basically heist them. Why? To prevent the system from collapsing. So what are you going to do to protect your money? This is what we have to ask ourselves. How can we diversify our portfolios so that we have a greater control over our assets as opposed to somebody else? And so what I want to do, I want to share just some quick, benefits so you can understand how life insurance does, what are the benefits of having life insurance as your own banking system, as well as how to use it to supplement your retirement. So let's jump into that. One of the first things that you're able to do is pocket the interest that you now pay to financial institutions. So in 2014, I wrote this book called You Be the Bank, Finance Yourself to Wealth. And what this book does is it shows you how to use a form of permanent life insurance. In this case, I refer to the vehicle, the IUL, which stands for Index Universal Life Insurance. okay? And I'll show you how to use it to do just that. So instead of you going to Bank of America and Toyota Financial and all these big banks that we tend to go to fund our lifestyle, to buy cars, to buy houses, to get loans for college, all of these things that we do, you can use your life insurance plan to do that instead and pay your own self back that interest that you would usually pay to these different financial institutions. In this book, I actually use an example. I show a real life example of a person who used this same concept to buy a car, and they do it every 5 years. And so as they're paying that car back, they're watching their cash value continue to grow each and every year. All right. So that's one of the things. And you can get a copy of this book, by the way, at youbethebankbook.com. youbethebankbook.com. Okay. The second thing is you're able to recapture the entire purchase price of things that you buy over a reasonably short period of time. Exactly what I was just explaining here. You're able to recapture. So when I use the example of the car in this book, that whole purchase price of that car was now put back into the life insurance policy in the form of that cash value. It increased the cost of his car, which usually what happens after we purchase a car, we pay it off, and all of that money that we spent, it goes into the column for the financial institution as an asset for them, right? And it becomes a donut for us, right? It's no more benefit. We've basically transferred all of our resources over to them. So you're able to recapture those type of purchases in a reasonably short amount of time. You grow wealth without risk. Everything else that typically that we use today to accumulate growth, it comes with some level of risk. Whether, the lower the risk, the lower the reward. But with life insurance, there is no risk at all. Your money, you cannot lose money. Your cash value cannot go down unless you're using a variable life insurance. And we're not recommending that type of life insurance. We're only talking about two types, either whole life or index universal life, okay? So your money is able to grow without risk. Another benefit is that you increase your cash flow by an average of 20 to 30% simply by changing the way that you buy things. So again, instead of going to these financial institutions, you're able to tap into your bank. And not just when you turn 59 and a half, like a lot of the other retirement vehicles that you have access to, but guess what? You're able to capture you're able to tap into that cash value at any time. So imagine being able to use your plan as a bank year after year, every 5 years or whatever, and you're constantly creating that velocity of money along the way where you're able to leverage the cash value in your plan to buy real estate. Or, okay, because I use car, but what if we took it to another level and we started to invest in real estate? Well, guess what? That's what people are doing. Or you decide to invest in some other type of tangible assets, gold and silver, things of that nature. You have the ability. Or
your children's education.
Absolutely. I think that's one of my points here. It is. Or your children's education. I'll talk about that more in a second. And then when you finally do decide that you want to retire, right, then you're able to create a tax-free income stream that you can access how and when you want for a lifetime. Unlike our traditional retirement plans, which, by the way, there are laws in place that they're getting ready to regulate how you can liquidate or distribute from your retirement accounts. But in this vehicle, you won't have those type of limitations and restrictions, okay? And then you get to wake up at the beginning of each and every year with more wealth than you had the year before, no matter what happens in the stock market. Can you imagine that? Not having to worry about having another 2008 or 2001 to happen again, and having, imagine the people who had lost 37% of their portfolio when these things happen. Had they had a portion of their assets diversified into a plan like this, their money would not have lost one penny. So imagine that type of peace. Okay, I got to keep moving. Peace that you can have there. And then also, as Darlene mentioned, unlike other assets, it's not listed on the forms needed to qualify for student aid, loans, and grants for college. So therefore, you're able, for those of you who are in that sandwich generation right now, you may have some kids who are preparing for college and you're paying for college expenses. Guess what? The assets that you've accumulated in your cash value plan, it won't count again. It doesn't count against you. Okay, so you're able to qualify for college assistance. And then your cash is protected from lawsuits and bankruptcies. Don't think that you get sued. Guess what? All of everything else that we traditionally, utilize, they're all exposed. They all have the opportunity to be sued against. Okay, and liquidated. And then of course in the divorce, okay, we're not, we're not advocating you withholding anything from your spouses or anything like that, but in a divorce, your TSP, your 401k, etc., all of those things can be part of the settlement. And since the gains from your life insurances are not reported on your taxes, it's private. It's private. Your spouse doesn't have to know about it, and it is protected from divorce settlement. Okay? These are just some benefits. And then lastly, but not least, and this is a huge one here, because this is an area when we're planning for retirement that rarely gets talked about, except here at ABS, we talk about it all the time, is the cost of health care in retirement. And so some of these plans provide protection for long-term care and chronic care expenses, all built into that. So there's so many benefits that you get, okay, by having a plan like this. And guess what, folks? The wealthy, they've been using this stuff for years, and they've been thriving, okay? And unfortunately, it's one of those things that have been withheld from middle America for so long. They don't teach us about these things. Nope. And so we're here just to give you a different perspective, to educate you on the area, on this particular area that unfortunately, again, you don't know about. So connect with us so we can see if this is something that fits your individual situation. It's not for everybody. Let us be the first to tell you that. You have to qualify for these things in different ways. It's just not a concept that works well for everybody, but we'll never know until we're able to sit down and look at your individual situation. So with that being said, Darlene, I'm throwing it back to you. I think my time is up, and you can wrap it up and give our viewers any closing instructions on what they need to do to see if this is something that will work well for their individual situation.
Yes, absolutely. Thank you so much, Javon. And we're joined back again with Rita before we again just encapsulate what are your insurance needs. We have been putting this be your own banker concept into practice with our own clients. And Rita, do you have a scenario that you want to share with our audience about what you've helped to do with your client?
Sure. I'm back, you guys. I am the coffee addict, so I went offline so Rita can have her Java. So she's back, and she got a little more energy for you. But I wanted to share that I've been doing this concept maybe for about 9 years now, and I'm going to give you two scenarios. I have a nephew who was just giddy. He got a good promotion up to 6 figures, and he was thinking about doing his 401k. They matched him on his private company up to 3%, but he wanted to invest the whole $18,000 that he could into his 401k. So what we did, we took and let him take the 3% because that's free money that he was going to get from his 401k. We talked about that a few weeks ago. Then we took the other portion, less out the tax. He's putting $500 away into one of the plans that Javon just talked about. $500 a month. He doesn't have to increase it. 500 from 28 to 60. And at 65, this young fella is going to receive, per the estimate, $100,000 a year till he's 100. But let's look at it this way, because I'm an accountant, I'm very conservative, and we know that nothing always is how we project it. So let's assume that it's not 100,000, and somehow the market doesn't do as good as we project, and he only gets 60,000. Can you imagine investing $6,000 a year to get $60,000? That's a serious what? That's 10 times return. That's 1,000% return on your money from something you did with this concept. And he's able to use it all along the way. I have another client, his wife died. He got a lump sum of money from her insurance claim. Rita, what do I do with this money? I want to prepare for my daughter for school, and I also want to create some more retirement money because he works for the government and he works in the district. We took 75,000, dumped it into this plan. It gave him an instant $400-something thousand that he could leave to his daughter. His whole purpose was she was 5. At 18, he's going to withdraw $25,000 a year for 4 years to help pay for her college. And then at 65, he'll then start drawing about $30,000 a year for himself in tax-free retirement income from one lump sum he was able to drop in there 75,000, let it grow for 10 years before his daughter goes to school, then she's out of school, and then it grow another 8 years before it's time for him to retire. Last month, my client worked for the government. She retired from thrift. She had 300,000. She got 3 kids. I want to leave this to them. Why would you leave your girls who's under 59 and a half money that's going to be taxed and they're going to get hit with some penalty? What do I do, Rita? Well, we took her free withdrawal out of her annuity for 10 years. We moved the money into a vehicle that created her wealth, moved out the money for her RMDs. That RMD purchased this policy. She only paid for 10 years. So day one, her $11,000 created $312,000 tax-free money. So now her girls are getting $300,000 tax-free and not $300,000 of qualified money that they will lose part of in taxes. And she still has the opportunity to spend the entire 3 because her RMD is less than what she's earning on her money. So we created 2 real pools of money from that. Talk to us, Rita. I've been doing this for years, and we just had this great Javon who, she's me and Darlene old school merging into new school. Javon is new school. She's bringing us up into the 21st century. So she's on her game and her stuff. So she helps us be more. See, we online because she was like, y'all got to do something. So we sharing with you because of Javon. So I thank you, Javon. But this company, call us. We know how to help. Don't just look and keep looking and keep waiting and keep waiting. Procrastination is the thief of our tomorrow. And what does that mean? It steals our retirement growth, because if you're not growing it now, you're going to wait till it gets closer to the time for you to retire. Give us a call. And guess what? It's Fed Friday.
Yes, thank you so much, Rita. Thank you, Javon. I don't know if you all caught that, but this is worth repeating. She just gave you a strategy of how to turn your tax deferred money and pass it on to your heirs tax-free. You understand what that means? Mm-hmm. Tax-free.
Powerful.
You need to give us a call. So what are going to be your insurance needs? We're just going over right now liquidity needs for retirement income, housing, spouse, caregiving, your life insurance benefits that are stored up, your cash value. Hey, that doesn't get looked at when they're doing your needs analysis. So give us a call. And guess what, you all? Many people out there, Rita sent out a series on the beneficiary review, which we will do again. And if you want to get that beneficiary review, please contact us. Our information is right here. But guess what? Give us a call just to do a policy review or a beneficiary review.
That's right.
So thank you all. You got to come back next week to get more information when we dig even deeper into using that permanent insurance to help fund your retirement and do some other things. So we got some more strategies for you. Please come back. We look forward to seeing you next week on the broadcast. It's Fed Friday. Thank you, Javon. Thank you, Rita. Thank you all.
Pleasure. Thanks, ladies. Everybody have a great day.
Javon was long-winded, not me.
I'm sorry.
If anyone has a question, if you're still on, please, we're still here to take your questions if you have a question.